Welcome to a comprehensive guide on 5 low-risk investments that deliver impressive passive returns. If you're looking to grow your wealth without taking on excessive risk, you've come to the right place. Building a stable financial future doesn't require you to gamble with your money or chase risky ventures. Instead, there are proven investment strategies that have helped countless individuals generate consistent income over time. Let's start by understanding what we mean by low-risk investments. A low-risk investment is one where the chance of losing your principal is minimal. These investments typically have stable, predictable returns and are backed by established institutions or tangible assets. Passive returns, on the other hand, refer to income you earn without actively working for it day by day. You make the investment once, and then the money works for you automatically. The first investment we'll explore is dividend-paying stocks. Many investors overlook stocks when they think about low-risk investments. But the reality is that certain stocks are incredibly stable. Blue-chip companies, which are large, well-established corporations with strong histories, often pay consistent dividends to their shareholders. These are companies that have been around for decades, sometimes centuries, and they have proven their ability to weather economic storms. When you own dividend-paying stocks, you're not just betting on the stock price going up. You're receiving regular cash payments from the company simply for owning a piece of it. Many of these dividend payments arrive quarterly, which means you get income 4 times per year. Over time, this compounds significantly. You can reinvest those dividends to purchase more shares, which then generate their own dividends, creating a snowball effect. The beauty of dividend stocks is that they provide both stability and growth. While you're collecting quarterly payments, the underlying value of the stock may also appreciate. This dual benefit makes them an excellent choice for conservative investors who still want their wealth to grow. Historically, dividend-paying stocks have returned around 8 to 10% annually over long periods, though past performance doesn't guarantee future results. The second investment worth serious consideration is bonds. Bonds are essentially loans you make to governments or corporations. When you buy a bond, you're lending money to the issuer, and in return, they promise to pay you interest at regular intervals. This is one of the most straightforward passive income strategies available. You know exactly how much you'll earn and when you'll earn it. Government bonds, particularly those issued by stable countries, are among the safest investments you can make. The risk of the United States government defaulting on its bonds is extremely low because the country has the power to tax and print currency. Corporate bonds from financially healthy companies also offer excellent returns with manageable risk levels. The interest rates on bonds vary depending on the creditworthiness of the issuer and the length of the bond term. What makes bonds particularly appealing is their predictability. Unlike stocks, where dividends can be cut or eliminated, bond interest payments are contractual obligations. The issuer must pay you on schedule or face severe legal and financial consequences. This certainty makes bonds perfect for investors who prioritize steady income over rapid growth. The third investment we're discussing is real estate investment trusts, commonly known as REITs. A REIT allows you to invest in real estate without actually buying property yourself. Instead, you're buying shares in a company that owns and manages real estate properties. These can include apartments, office buildings, shopping centers, warehouses, and healthcare facilities. REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends. This makes them exceptional passive income vehicles. You can start with relatively small amounts of money, yet you gain exposure to professional real estate management and diversified property portfolios. The real estate market has historically been one of the most stable and wealth-building asset classes available. One major advantage of REITs is liquidity. Unlike owning actual real estate where selling property takes months, you can buy and sell REIT shares instantly during market hours. You also avoid the headaches of being a landlord, dealing with tenants, maintaining properties, and managing repairs. Those responsibilities fall to professional management companies. Meanwhile, you collect your dividend income regularly. The fourth investment option is peer-to-peer lending platforms. These platforms connect borrowers with individual lenders like yourself. When you lend money through these platforms, the borrower pays you interest as they repay the loan over time. This interest becomes your passive income. You're essentially becoming a bank on a small scale. Peer-to-peer lending offers returns significantly higher than traditional savings accounts or bonds, typically ranging from 5 to 12% annually, depending on the risk level you select. The platforms carefully vet borrowers and assign them risk ratings. You can choose to lend to the most creditworthy borrowers for more modest returns or take slightly higher risk for higher yields. By spreading your money across many different loans, you minimize the impact of any single default. The beauty of peer-to-peer lending is that you're helping real people achieve their goals, whether that's consolidating debt, starting a business, or making home improvements, while simultaneously building your wealth. The monthly income streams arrive like clockwork as borrowers make their payments. It's a win-win arrangement. The fifth investment to consider is high-yield savings accounts and certificates of deposit. While these might seem boring compared to stocks and real estate, they're an essential foundation of any low-risk portfolio. In today's economic environment, many high-yield savings accounts offer interest rates between 4 and 5% annually. Certificates of deposit, or CDs, often offer even higher rates in exchange for locking your money away for a specific period. These investments are insured by the Federal Deposit Insurance Corporation, or FDIC, up to $250,000 per account. This means that even if the bank fails, your money is protected by the government. You literally cannot lose your principal with FDIC-insured accounts. They represent the ultimate in safety while still providing genuine returns above inflation. The advantage of having a portion of your portfolio in high-yield savings and CDs is peace of mind. You know your money is safe, you know your returns, and you have quick access to funds if you need them. This creates a strong foundation upon which you can build more aggressive positions in stocks, bonds, and real estate. Now that we've covered 5 specific investments, let's discuss how to construct a diversified portfolio from these options. The principle of diversification is absolutely critical. You should never put all your money into a single investment, no matter how safe it seems. By spreading your capital across multiple investment types, you reduce your overall risk while maintaining solid returns. A common approach for conservative investors is the 60-30-10 split. 60% might go into dividend stocks and REITs for growth and income. 30% might be allocated to bonds for stability and predictable returns. The remaining 10% could be in high-yield savings and CDs for maximum safety and liquidity. However, the exact allocation depends on your age, risk tolerance, and financial goals. Younger investors can typically afford to take more risk because they have decades for the market to recover from downturns. Someone in their 20s might allocate 70 or 80% to growth-oriented investments. As you approach retirement, you'd gradually shift toward more conservative investments like bonds and high-yield savings. This process is called asset allocation glide path, and it's one of the most important concepts in investing. Let's talk about the power of compounding, which is often called the eighth wonder of the world. When you reinvest your passive income, it begins earning returns of its own. This creates exponential growth over time. A modest passive income stream that compounds over 20, 30, or 40 years becomes genuinely life-changing wealth. Consider this example. You invest $100,000 in a diversified portfolio earning 6% annually. In the first year, you earn $6,000. If you reinvest that, in year 2, you're earning returns not just on your original $100,000, but also on the $6,000 from year 1. This gap widens exponentially as time goes on. After 30 years, that $100,000 has grown to $574,000, more than quintupling your initial investment, without you adding another dollar or doing any active work. The time value of money means that you should start investing as early as possible. Even small amounts matter enormously when given decades to compound. Someone who starts investing at age 25 with just $200 per month ends up far wealthier at retirement than someone who waits until age 35 and invests twice as much. Time in the market beats timing the market every single time. When you're selecting specific investments within each category, do your research carefully. For dividend stocks, look at companies with histories of stable or increasing dividends over many years. For bonds, check the credit ratings assigned by agencies like Standard & Poor's or Moody's. For REITs, examine their dividend history and the quality of properties they own. For peer-to-peer lending, review the platform's default rates and borrower screening processes. For savings and CDs, compare rates offered by different banks. It's also crucial to maintain proper perspective on market volatility. Stock prices fluctuate daily, and during recessions, they can drop significantly. However, if you're relying on dividend income rather than selling shares, short-term price fluctuations don't directly affect your income. This is why dividend investing is so powerful for passive income. You're not trying to time the market or sell at peaks. You're collecting income regardless of whether the market is up or down. Many beginners worry about making the wrong choice and losing all their money. The good news is that by sticking to established, low-risk investments, this scenario is highly unlikely. Blue-chip dividend stocks have rarely gone to zero. Government bonds are backed by the taxing power of nations. REITs are professionally managed by experienced teams. Peer-to-peer lending platforms have track records spanning over a decade. High-yield savings are insured. The combination of these strategies creates a fortress of financial security. Another key principle is tax efficiency. Different investment types have different tax implications. Dividend income, bond interest, and REIT distributions are all taxed differently depending on your situation. By strategically placing investments in tax-advantaged accounts, like IRAs and 401k plans, you can significantly increase your after-tax returns. It's worth consulting with a tax professional to optimize your strategy. Let's address a common misconception. You don't need to be wealthy to start investing. Many of the investments we've discussed can be started with modest amounts. You can buy individual stocks through brokers with no minimum investment. Bond funds can be purchased for as little as $50. REIT shares trade like stocks and require only the commission to buy one share. Peer-to-peer lending platforms typically require minimums of $25. High-yield savings accounts have no minimums at most banks. The key is consistency and patience. By regularly adding to your investments and giving them time to compound, you build wealth systematically. This approach is far more reliable than trying to get rich quick with risky speculation. Wealthy individuals didn't build their fortunes through lottery ticket investments. They built them through disciplined saving and strategic, diversified investing. It's also important to periodically review and rebalance your portfolio. As different investments grow at different rates, your allocation will drift from your target percentages. At least annually, you should examine your holdings and reallocate funds to bring your portfolio back in line with your plan. This naturally enforces the principle of buying low and selling high, as you're typically selling the best performers and buying the worst performers. Monitoring your investments shouldn't consume your life. This is passive income. You don't need to check prices daily or make constant adjustments. Quarterly or annual reviews are typically sufficient for passive investors. Many successful investors deliberately check their portfolios infrequently because they know that constant monitoring leads to emotional decision-making. Emotional decision-making typically reduces returns. Let's discuss inflation, which is the silent killer of wealth. If your investments return 5%, but inflation is 4%, your real return is only 1%. This is why it's important to ensure your portfolio grows faster than inflation. The 5 low-risk investments we've discussed historically have outpaced inflation over long periods. Dividend stocks and REITs provide growth. Bonds and peer-to-peer lending offer higher yields than inflation. High-yield savings accounts currently offer returns above inflation. One final concept to understand is the difference between capital appreciation and income. Capital appreciation is when your investment increases in value. Income is when your investment pays you money. Low-risk investing emphasizes income because it's more predictable and not dependent on market fluctuations. However, you typically get both. Your dividend stocks appreciate over time. Your bond values change. Your real estate values rise. This dual benefit is why these investments are so powerful. The psychological benefit of passive income cannot be overstated. Imagine having money flowing into your account every month while you sleep, every month while you work your job, every month while you're on vacation. This creates a sense of security and freedom that is genuinely priceless. You're no longer dependent entirely on your job for income. You've created multiple income streams that support your lifestyle. Starting today, you can begin building this passive income machine. Choose 1 or 2 of these investments to begin with. Research thoroughly. Start small if we're uncertain. Open a high-yield savings account immediately for the foundation. Buy a dividend ETF for simple stock exposure. Explore one bond fund. Look into a REIT. These first steps take only hours, but set you on a path toward financial independence. Remember that you don't need to be a financial genius to be a successful passive investor. You don't need to predict market movements or beat professional traders. You simply need to choose quality investments, hold them for the long term, reinvest your returns, and stay disciplined through market cycles.